Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, May 9th, 4:55 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, large caps continue to be in an uptrend. Medium caps or mid caps and small caps continue to underperform. Avoiding regional banks and commercial real estate is what we're doing right now. Check over here the trend gauge. Leadership neutral with an underlying bullish bias. Short term, the five major indexes are split. Actually, they're split across the short term, medium term, and long term. Using the short term 21-day moving average. Uh, for medium term, we use the 50-day moving average. For long term, the 200-day. In all cases, the big cap indexes, the S&P 500, the Nasdaq 100, and the Dow Jones are above all three moving averages, and mid caps and small caps are below. This is, of course, the fallout from the reaction to fear in the regional banking sector, and that continued today. Not as harsh as it has been, but we saw started with a gap down and then a comeback and then a little bit of a sell-off. So no major blow-ups. That's good. What happened today? Tightest close of the year. The range was 1/3%. But we closed red across the board. Market waiting for CPI in the morning and then PPI on Friday. We'll see what the reaction is to that. Mostly all of the earnings, over 90% of earnings in the S&P 500 have come in now, and for the most part, they've versus historical norms, they've outperformed relative to the typical quarter. Now, this is with the understanding that uh, expectations were lowered for the first quarter, but analysts are somewhat raising their expectations for the rest of the year. The market still pricing in a recession and rate cuts later in the year. Of course, we know Jerome Powell has said no to that. We'll see where the rubber will meet the road and who wins as we get down the line. But here are the numbers on the day. They're red. Not too bad. Really, what we get concerned about is, was damage done to the indexes? The answer is no. Was damage done to leading stocks? And again, the answer is no. Our 7 ETF growth composite, the RG7 down 0.1%, S&P 500 down less than 0.5%, Nasdaq 100 down 0.6, Dow down 0.2%, mid caps down 0.4, Russell 2000 small caps down 0.3, global diversified 60/40 stock bond index down 0.28%, dragged down by stocks primarily, but bonds were also slightly in the red today across the board as yields rose just a bit. In-house GROTECTION down 0.52%. It's Titan 25 Tuesday. We'll show the update. Remember, no matter how much fear you have of what's going on, as long as these 25 stocks don't break down, the big cap indexes will not break down, and therefore the market won't break down. So focus on what's working, stay away from what's not working, and you'll survive just fine. So here's the S&P 500. This little tiny itty bitty red dot here was the entire range for today. Let's go to a 60-minute chart. If you combined today's range and yesterday's range, they're both, they weren't inside days, but combined, they're inside the range from Friday. So typical after a big move up to take a little bit of a break. That's what we're doing. And in taking that break, the 60-minute stochastic is cooling off back down near oversold, which would be under the 20 level. And we can get some decent moves to the upside when we get oversold, and then we do the slingshot back above the 20. How fast does it go? We never know. But we're coiling with this very tight range over the last 2 days. So market setting up for a move one way or another. For now, we're holding on to the 21-day moving average on all on all three of the big cap indexes. Here's the Nasdaq 100, very tight range today. Also, let's go back to the 60-minute, and you can see actually an inside day versus yesterday. But yesterday we poked our head above Friday's high on the Nasdaq 100, and then tight range pullback today, coming into oversold on the stochastic as the market takes a breather. Dow Jones Industrial Average sitting basically right on the 21-day moving average. Same setup as the other two. Two tight days relative to Friday's up move. You can see how tight today was on the Dow, similar to the other indexes. Now let's go to mid caps. Tried to get back above the 21 and the 200 yesterday, failed. Tight range again today. Uh, a third of a down, a third of a percent, closed about mid-range. No additional damage done. On the 60-minute, you can see here we didn't quite get to oversold, and then we hooked up and now hooking back down. We didn't cross, but so basically this is reflecting prior weakness and hasn't come down to the degree that it went up, which is what we saw on the big cap indexes. And that's because we really didn't make the big move in the big cap indexes on Friday. In the mid and small caps, we didn't make the big move that we made on the Dow. Actually, that's not quite accurate. We were up more on those, but relative to that move, because we were stretched to the downside, the stochastic hasn't hit overbought yet. IWM, small caps, down a third of a percent tight, but put the low in pretty early in the day today, and then tried to rally into the end of the day, still below the declining 21. That's really the key. That's what we need to break. That's where we've been for over 2 weeks now. Trending below declining 21-day moving average is not good. You can see on the stochastic we've crossed up from oversold on the daily, didn't hit oversold on the 60-minute. So really what we want to see here is a move back above. And again, this is going to pretty much be dictated by the fears of regional banks. We gapped down. Let's go to the 5-minute chart on this. You can see we gapped down, made a lower low. Then we stopped going down, just went sideways, a little bit of strength in the afternoon, and then a flag into the close. This strength came out when they did a feature on CNBC, that the Treasury said that they will always pay the interest on T-bills, even if they hit the debt ceiling, because there are some other things that are freeing up, and they'll do things like close national parks and uh, suspend payments on other things, but not a fear for Treasury bills, and that spiked bonds up, or banks up on that news. Definitely keeping our eye on KRE before we can't even get above the 8 EMA on KRE. So we do have our small FAZ uh, bank inverse bank short play, where in other words we're short the banks via FAZ and in an inverse ETF, which moves based on XLF, the banking or the financials portion of the S&P 500, our stop above yesterday's high in XLF. So let's get to the dollar now. Dollar strong all day. Here's a 5-minute. It gapped up, faded a little bit throughout the day, but didn't give much back. But the big change was that it was a close above the 21-day moving average. We had two closes above last week before fading again back above the 21 now. We don't want to see strength in the dollar. That is negative for precious metals. It's negative for the market, or at least it has been. How tight that inverse correlation remained. It was challenged a little bit today as gold was up also, along with the dollar being up, as gold pulled back and bounced off the 21. GDX gold stocks, however, were not up, down a third of a percent, very tight range, still above the 8 EMA. And silver, basically unchanged today, down fractionally, very tight range. Lots of tight ranges today across everything, as not a whole heck of a lot went on as we're waiting for that inflation data tomorrow morning. Let's flip to bonds now. BND bonds also traded very tight today. Uh, Price down, meaning yield up, sitting on the 50-day moving average here on the broad bond index. TLT, the 30-year, still near the lows of its range, pulling back even tighter. down a third of a percent, which means the 30-year yield was higher by 0.34%, up at the top of the range. And TNX, the 10-year, basically flat today. And it's hanging near the top of the range, really in about the top third of the range, and above the 21-day moving average. How about Bitcoin? We had that uh, fear yesterday with Bitcoin as Binance paused withdrawals. A little bit of a bounce back today, but still below the 50-day moving average and right at that 16 level. Go to a 60-minute, you can see how the 16 level has been had been support. We broke below it yesterday, closed right at that support level today. So those are the major ETFs and asset classes that we track on every video. Let's go to the tail of the tape. You can pause this, read the whole thing. VIX up 4.3% today, still below the 21-day moving average. I didn't show that chart, did I? But here it is. The VIX, we're below the 20 level, we're below the 21. Tight range today, which would be expected as the markets were in a very tight range today, but below the 50, below the 21, and below the 20 level is good for stocks. We don't want to see any panics on that. That will more than likely mean uh, the opposite of what's going on for stocks. So VIX up, stocks down. Wednesday morning before the open CPI, we'll be looking at that day count from up one with a consolidation day to up one with two consolidation days. We're basically right on the ADMA on the S&P 500, third day above the 21 on the S&P 500. Our expectations remain positive as long as we remain above there. Tight range today, as I said. Uh, Tightest day of the year, in fact. Gap down and really didn't do a whole lot since then, since that gap down at the open. Very tight trading. So on the plus side, bond yields not by much. The dollar, aerospace, small cap biotech, small and mid cap biotech, I should say. IBB, if you ever see that in here, that's large cap biotech. That was down slightly, while XBI, led by CRISPR, was up. IGV, that's big cap software, as CRM and Microsoft had decent days. Gold, positive on the day on the downside, bond prices. KRE, that's regional banks and semiconductors. Here's our focus list. We'll take a look at a couple charts here momentarily. First, we'll talk about the portfolio. All we did today was add to our Lulu position. Lulu gapped down in sympathy with Under Armour, which had a bad reaction to earnings, but it was bought up immediately. We'll take a look at that chart. And then we added to Uber also. Bottom line, lower on the tightest day of the year, a third of a percent range. We continue to go lower on the ATR for the S&P. The lower the ATR, the lower the volatility, as you're seeing in the VIX. It's considered to be bullish for stocks. Coiling for CPI in the morning. That's what we will be reporting on in tomorrow's video. Let's get to some charts now. I mentioned CRISPR. Uh, this is they lease their technology to a bunch of different biotech companies. They really don't have any earnings to speak of. They're waiting for one of these biotech companies to hit a home run with a drug, and that's when they will reap the rewards. But it was up. They did report earnings, and it was up 13% on the day, and that sparked the XBI, which has, in a calm market, actually shown serious relative strength over the last week and a half. That's the small cap biotech index. What other stocks do we want to show? Well, let's show Lulu first of all, since we added to that. We'll go with, geez, come on. We'll go with the 5-minute chart so you can see what I was talking about with the gap down in sympathy with Under Armour. Immediately bought up, then tight the rest of the day along with the indexes. This is what you'd like to see when a leading stock gets. It's been riding the ADMA higher, closed basically right on the ADMA, gapped below it, got back to it by the close. Um, Good stuff for Lulu. And then we also added to Uber. Uber has been acting great since its big volume earnings gap up, continuing to trend higher. Tight inside and range today on the 30-minute. You can see the deep move down and then the hookup on the 30-minute. This is when we added just a percent to our existing position on that. Let's see. How about some earnings reports? Shockwave, initially lower, but bounced at the 21, closed higher by 3.7%. This is forming a very nice cup with handle, and we're going to make sure we don't miss that. It's on our list that we keep up all day as a focus, but don't want to miss that alert. And then after hours, Celsius. Uh, Beat its highest sales estimate. It is up 8% after hours. This has been forming a very nice cup. We've been pointing out the volume on that. Uh, Michael pointed this out to us early. We don't own it, but we might tomorrow, depending on how the volume and the price action act tomorrow morning. We have 9 stocks in our portfolio, room for one more. It might be Celsius. We know what it won't be as of right now, and that's Airbnb. As it started to form a very nice cup, reported earnings, it's down 10% after hours. So destroying the nice gap up with volume leading into its earnings report. So thumbs up for Airbnb, or thumbs down for Airbnb, thumbs up for Celsius. Let's take a look at AEHR. They signed a contract today up 5%, coming off the 200-day moving average. Now, the 200-day is a spot where value-minded portfolio managers, excuse me, that know a story, know the company, will frequently buy shares to put in support. That's, as you know, we talk about it forever, the 200-day moving average, not only on indexes, but on individual names also, is the difference between a constructive chart and a destroyed chart. And this bounced just how you'd want it to. Now trying to put in or start putting in the right side um, of its cup. And as a reminder to always obey your stops, we're going to close with a chart of Upstart, which after hours on earnings is up 40%, was up 50%. But what can we say about, first let's go to how it's been acting recently because it's so tight. So, no big deal on Upstart, right? But if you go to a monthly chart, you can now say that Upstart is up 40% today, and now it is only 95% off of its all-time high. Bill O'Neill has a stat that the average leader, when it tops, corrects by 72%. Well, 72% is the average. Chalk Upstart up in the column for stocks that corrected more than 72%. And with that, we're going to wrap it. As always, like to hear from you. Let's show you why we do what we do here at Revere very quickly before we go to the Titan 25. Avoiding these big losses in bear markets. That's our number one mission. The returns will take care of themselves when we get a strong market in the indexes and leaders all rowing in the same direction. Let's look at this Titan 25 now. And a lot of data here, but let me summarize it very quickly. We're looking at the 21-day moving average and the 50-day moving average, and we assign different colors to them, where they are relative to those moving averages. In gray was where the percent that it was above or below the 50-day moving average last week, and in the white column next to it is where it is this week. Same thing relative to the 21. So of these 25 Titans, we have 9 still above, still at least 1.5% above their 21-day moving average, and we've got 12 of them 3% or more above their 50-day moving average. So here's the breakdown of if you're over 8% but less than 1%, versus the 21, there's 5 of them there. If you're between -1 and -2%, there's 4. 2% below, there's 7. So no significant damage here. And then look at the 50-day moving average, 20 of them are either 3% above or within 2% of their 50-day moving average. Three of them below, more than 4% below. Two of them between 2 and 4%. So, as far as improvement or getting worse or about staying the same, 11 charts improving since last week, 8 staying the same, 6 going a little bit worse. So the bottom line takeaway on this is that as long as these 25 aren't flashing all red and yellow, the indexes are going to be holding up just fine. And this is a diversified group. 17 different sectors make up the Titan 25. 22 of the 25 have reported earnings. 3 of them crushed it. 9 of them had a positive reaction. 3 of them a so-so reaction. 4 of them a mildly negative. 3 of them a bad reaction. Those were Tesla, TMUS, and United Healthcare. That's T-Mobile, TMUS. So that's the Titan 25 summary for Tuesday. Because I'm a sucker for alliteration, Titan 25 Tuesday, and tomorrow will be weekly chart Wednesday. Aren't you enjoying it? I know I am. And with that, I'm going to wrap it up. Remember, it's not how much you make in the markets, it's how much of that you can keep. If you're interested in talking to us, reach out. Don at RevereAsset.com, my partner Dan Stewart, Dan at RevereAsset.com, or the phone is 855 Real Wealth. That's 855 732 5932. And with this, I will wrap up the video for Tuesday, March 9th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.